Hey everybody, this is Greg Gossett from Gossett Trading, and today is Saturday, December 6th, 2025. Hey, how's it going? How are you doing? I hope you had a good week last week. I hope you had a good trading week and made some money. And I appreciate you coming to my weekend review podcast. And hopefully, this is going to be helpful for you. I think I have some good things to teach you. The format for the podcast today is, first of all, we are going to run the U.S. legal disclaimer, get that out of the way. Secondly, we're going to come back. We're going to take a look at all the trades and the positions that I have from last week. We're going to talk about when I entered the trades, why I entered the trades, what the confluences were when I entered, where I'm placing my emergency stop, where's my end of bar stop, how I take partial profits if this trade moves my way, and then ultimately how I get out of the trade uh, to the upside or to the downside. I have a lot of trades. I have a lot of positions that I'm in based upon different strategies and entry signals that I have. So I think it'll be a good opportunity for you to see many different trades, many different trade situations, and how I am managing them. Also going to talk about the trades that I got stopped out of. But what I want you to kind of take note of, if you don't mind, is when I have a losing trade, generally it's pretty quick. Maybe I'm in the trade 2, 3, 4, 5 days, and it becomes and then I get stopped out. Okay, that's it. I'm done with the trade. But in general, I have a lot more winning trades than losing trades, but you'll see, because I do this every week, you'll see that the trades that are still above my stop and are doing fine, I keep those, right? I have patience with the trades that are doing well, and I have a process that tells me when to get out of them, either to the upside or the downside. But just like I said, in general, my losing trades, when I have losing trades, they're pretty quick. I'm in it. Oh, I stopped out. I'm done. But I keep the ones that are working for me. And that's what I would like to suggest to you. Be patient with your winning trades. Be impatient with your losing trades. You look back at any back test of good trading, you'll see that the losing trades, the amount of days that you were in were very few, really. And the ones that are have not stopped out, you're in those for a long time. And that's just being patient with your winning trades, being impatient with your losing trades. But you need a process to tell you, am I in or am I out? I've been trading for over 30 years, and if you just are impulsive about it, like, I think that's enough, I just get out. Or, well, I think I'm out over here. Or, no, I think I'm going to stay in this one, but not this one. It's a pain in the butt. It really is. It's a lot more holistic way to trade, to just have a process. And whether you learn that from me or someone else, great, but learn it. Okay. So we'll take a look at all the trades I make, all the positions I'm in, the ones that I'm still in, the ones that I got out of, and hopefully this will be helpful for you. If it is, I would really appreciate it if you could hit the thumbs up button. It really does help the channel, lets YouTube know there's some valuable content. And if you haven't subscribed yet, if you could subscribe, that would be wonderful as well. So after we've taken a look at the current positions, we're going to talk a little bit about trader psychology. Most important skill in trading by far. It's not chart reading. It is the ability just to have a plan, even if it's a simple plan, and then simply follow it. That is the key. I talk about this each week, but I really sincerely mean it. Get yourself a process and just follow it. Sometimes you're going to have good days, sometimes you're going to have bad days, but if you stay in your process and follow it with laser beam focus, I promise you over time, you're going to do much better than if you didn't. Okay. And then after that, I did go down through my master watch list last night, and I was looking for some potential trades for next week. Now, these trades are not where they need to be, but they're getting kind of close. They have a chance of triggering. And what I'm looking for is I'm looking for a confluence combination of levels lining up, whether those are order blocks, whether those are RSI readings, whether those are major moving averages, whether those are V1s, V2s. I'm looking for all of this. The trades that you have the most confluences, the more likely you're going to have a positive trade. It doesn't guarantee it, but it improves your chances, and that's about all we can do. So I'm going to share those with you, and hopefully that will help you get an idea of my process, my mindset of how I look at trades, oh, I forgot to mention too, risk to reward, right? Their risk to reward is a huge component. So we'll take a look at the trades that I'm looking for that are coming into major confluence areas, yeah, I'll keep an eye on those next week. So I hope that's going to be helpful. So let's go ahead and run the U.S. legal disclaimer, and we'll come back and get started. Hang tight, please.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, let's get started. So first open position that I have is USO, which is oil. And I entered here on the 20th of October at $67.81. So it's doing fine, doing great. So the first question is, why did I enter here? Well, I entered here because it rejected the top of the order zone, the order block. The order block is this green bar here that goes from the left to the right. When it's green, it is a bullish order block. And so I entered here, but what is an order block? So let me take you back to when this order block formed and kind of explain that. So the order block formed back here on the 30th of January, February, March, April, May, right? The 30th of May. So what makes this an order block? Okay, so in order to have an order block, this is the pattern that you need. First of all, you need a swing low. A swing low is a low that has a higher low to the left and a higher low to the right. And you can see this is the case. The bar to the left has a higher low to the left, and it also has a higher low to the right. So you need to start out with a swing low. Okay, swing low. That swing low has to be followed by a swing high. A swing high has a lower high to the left and a lower high to the right. And that is definitely the case, right? So we have our swing low and we have a swing high. Now, after you have that swing low and the swing high, you need another swing low. This is a swing low, right? Lower high to the left, lower high to the right. You need another swing low that's below the first swing low. So let's recap. Swing low, swing high, lower swing low. Would you agree? Now, when this is in place, the next important development is that we need to go above that first swing high. Remember, here's the swing high. Swing low, swing high, lower swing low, and then this bar goes above this swing high. And what does that do? That changes our market structure from bearish to bullish. Okay, so it's really, it's a nice thing to have, to know that when you see this happening, now you're in a bullish market structure. Swing low, followed by a swing high, followed by a lower swing low, and then we take out that swing high, which now changes market structure. And as soon as you change market structure, now you know exactly where your order block is. Your order block is the lowest closing bar prior to market structure. And so now I take the high and the low of this bar, I highlight it in the green, and I move the green into the future. Now, when we broke market structure here, was it correct? Yeah, sure was. In a big way. Swing low, swing high, lower swing low, market structure, and it just took off. Okay, this doesn't always happen. It happens sometimes, but this is what I want to point out to you. When you look at the prices up here at $83, in hindsight, when you look back to the order block, was smart money buying in this area? Yeah, clearly it was buying, right? We're way up here. People bought down here. In hindsight, 2020, yes, smart money was buying there, clearly. So I call this an order block, but I also really think of it as a smart money area. So it's a smart money area. I move the smart money area into the future. If in the future it comes back down to that smart money area, it's more likely to bounce there or go back up than not. Not always, for sure, because this was smart money at one time. It doesn't mean it has to be smart money in the future. But I'm just saying, from 30 years of experience, more times than not, it is smart money again. Okay, so again, we'll go into present day here and with the trade, but this is where the order block started. So now let's go back into present day of why I took the trade. Okay, I have the smart money area here. USO did its thing. Now in the future, it did come back down to that smart money, didn't it? And so I entered the trade here on May 20th at 67.81 because it rejected the high of the order block. So there's multiple ways to enter with an order block. Just in general, a rejection of the high, you can see it went into the order block, closed above it. That's a rejection of the high of the order block. Also, a rejection of the low of the order block would also be valid, which means it would go below the order block and then close back in. Another way to do it is if you have a moving average inside the order block, that gives you another line in the sand where you can enter inside the order block. But in this particular case, it rejected the high of the order block, so I got long at 67.81. Now, as soon as I get long, or decide I'm going to get into the trade, obviously I need to know how many shares I'm going to buy. And this is important. This is one of the most important things in trading is how many shares do I buy? The way that I do it's very simple is, and it's simple, but it's really good. It has to do with two things. It has to do with one, how much is in your trading account, and what is the value of the 2 ATR. An ATR just means average true range, how much it's going to move. There's a value for that every day. I times that by 2, that gives me my 2 ATR. Right now, at the moment, it's 289. Okay, so two things. How much is in my trading account, and what is the value of the 2 ATR? So as far as how much is in your trading account, let's just say I have $50,000 in my trading account. It works with any number, but let's just say I have 50,000. I take 1% of that. 1% of 50,000 is 500. If you had $100,000, 1% is 1,000. If you had $1 million, 1% is 10,000. Okay, so 50,000, 1% is $500. Then all I do is I take that $500, I divide it by the value of the 2 ATR, whatever it is on that day. 500 divided by 2.89 tells me to buy 173 shares. So the 2 ATR measures volatility. If volatility is higher, this number is going to be higher, and therefore this formula is going to have you buy fewer shares. If this number is lower, then volatility is lower, it's going to have you buy more shares. And this is very important, everybody. When volatility is very high, you need to be buying fewer shares. That's what people really don't understand. And this formula will do it for you, right? One more time, 1% of however much my trading account, 1% of 50,000, 500, divided by the value of the 2 ATR, tells me to buy 173 shares, okay? So now I know how many shares to buy. So rejection of the high of the order block, I entered 173 shares at 67.81. Okay, we've positioned size correctly, we've entered the trade. Now, the very next thing I do, which is very important, is that I take the value of the 2 ATR, remember 289, and I minus that from my entry point. My entry point's here, I minus it and put it down here. So why do I do that? Well, this is called my emergency stop. Now remember, if I have 173 shares and it goes down to my emergency stop, which is 289 below it, how much have I lost? I have lost $500 because I did the math. I've lost 1% of my account. Now, it's not fun to lose 1% of your account, but it happens. But, you know, a loss of 1% of your account you can come back from that. And that's the key. So I've set it up here with this formula so that if it does come to my emergency stop, I know, okay, I'm going to lose $500. But the good news is that this only happens about 5% of the time that you will hit your emergency stop. The other 95% of the time, if you have a loss or if I have a loss, it will be because of the end of bar stop instead of the emergency stop. And the end of bar stop, by definition, almost 100% of the time is going to be much closer to your entry than the emergency stop. So for this particular trade with rejection of the top of this order block, my end of bar stop is simply a close below the order block. The bottom of the order block is 66.03. Okay, so that's much closer than the 64.80 that's my emergency stop. So 5% of the time, in my experience, yes, you'll hit your emergency stop, you'll lose 1% of your account. The other 95% of the time, when you lose, it will be with a close below your end of bar stop, which is always going to be closer, so it will be less than 1%. Make sense? Okay, so we have a rejection of the high of the order block, enter at 67.81. I position size like I just showed you. I place my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. Okay, now the very next thing I do is I place what is called a trailing stop level, and this is the orange line. In general, in trading, if you take a trade and it moves your way a certain amount, you want to start to tighten up your stop, right? You don't want to give it all the way, all of the profits back. And so tightening up your stop, the way that I do it is using the trailing stop mode. And so what I do is I take my entry point and then I look for the value of the 1.5. You can see the 1.5 right here is $2.17. So I take my entry price plus the value, the 1.5, and I put it above and I draw the line. There is the orange line. When I take the trade in the future, if I get to this level, if I go 1.5 ATRs above my entry, now I go into trailing stop mode. If I reach it like I did on this bar, it doesn't mean I do anything. I don't take anything off. I don't do anything. But going forward, now I'm in what is called trailing stop mode, which just means once I reach trailing stop mode in the future, if I have a close below a previous day's low, I'm going to exit half. And by exiting half, I'm moving all stops up by half, right? Because I'm getting out of half. So I have found it's a very, very good way to do this. Okay, so now everything I've talked about so far as emergency stop, end of bar stop, trailing stop mode, these are all defensive moves. In other words, if the market goes against me, I have to take action. But I also like to play offense in my trading, and not just defense, offense. And how do I do that? I play offense by taking partial profits each day if there's a certain amount of move from the previous bar's close. So I'll show you exactly how I do this. It's very simple. And I'm in this trade right now, so I'll show you what I'm setting up for Monday. I change these every day. And what I do is I take a look at the closing price of the day. Right now, the closing price of the day is 71.92. That's it, right? Very simple. Closing price 71.92. So for Monday, I'm going to place 3 profit targets for Monday. And what I do is I take the closing price, 71.92. Now I look for the value of the 0.45 ATR. Here it is right here. The 0.45 ATR's value right now is 65 cents. So all I do, closing price, 71.92 plus 65 cents. 72.57 is my first profit target for the day, right? That's it. So 72 was the number? 72.57, sorry. So 72.57, we'll put it right there. 72.57 is my first profit target for the day. Now, I told you I placed 3. So that's my first one, 72.57. How do I get my second? All I do is take the first one, 72.57, and I add the 0.45 to it again, which is 65 cents plus 0.65. My second profit target for Monday is 73.22. So we'll place that up there so you can see. Okay, so now I have 2 profit targets. I'm going to do it one more time. I take my second profit target, 73.22 plus 65 cents. My third profit target for Monday, 73.87. So 73.87. Now I've got my 3 profit targets for Monday. So how do I do this? Well, going into Monday, let's just say I have 100 shares. I do this every day. I take 10% of however many shares I'm going into the day with, and that is how much I'm going to sell at each profit target. So if I go into the day with 100 shares, my first profit target, 10%, is 10 shares. So I'm going to put a limit order in for 10 shares at 72.57. I'll put another limit order in for 73.22 for 10 shares. And then I'll put the last one in, 10 shares at 73.87. Okay. Now, if Monday it goes down, then I'm not going to hit any profit targets, and I'll have to rework the profit targets the next day. But if it goes up kind of nice and hits one profit target, perfect. I didn't hit all 3, I just hit 1. If it goes up really nice, I may hit 2. That would be great. If it, you know, I've certainly hit 3 profit targets before. I've hit 7 or 8 in a single day, but that generally doesn't happen. So, I'm not going to spend the time to put in like 19 profit targets, right? 3 is about the likelihood of hitting is 3. All right. So that is how I play offense and I do this every day, 10% of however many shares I have going into the day, 3 profit targets as limit orders. And it really makes a big difference, everybody. Over time, to hit these little profit targets, one, you reduce your position size, you lock in profit. And also by reducing your position size, it takes a lot of kind of stress and anxiety off as well. But it just makes sense. In sports, you need to play offense, you need to play defense, right? And in trading, that's my sport, right? I play offense with emergency stop, the end of bar stops, going into trailing stop level. I play defense, and I play offense by taking partial profits each day into my 0.45 ATR profit targets. Okay, so that's kind of the basics of it all. And let's start at the beginning, and I'll show you how this trade played out. Okay, so again, I entered the trade 10-20-25 at 67.81. I position size, as I showed you. I placed my emergency stop 2 ATRs below. I placed my end of bar stop a close below the low of the order block. I placed my trailing stop level, the orange line, 1.5 ATRs above, and off we go. The next day, moved up nicely, hit a profit target, right? Next day, moved up very strong again. I hit multiple profit targets, and I got to trailing stop level. Again, I don't do anything. I'm just in trailing stop level, which means in the future, if I have a close below a previous bar's low, I get out of half of the remaining shares that I have. Next day, boom, up again, right? I just nailed that trade, thankfully, and I took off multiple profit targets into this move, okay? So I'm in trailing stop mode, but we haven't had a close below previous bar's low, and I've scaled out with those 0.45 ATR profit targets a lot already. Next day down, next day down. Here, we have our first close below a previous bar's low. After reaching trailing stop level, what do? I take off half of the remaining shares that I have, and I took off half there and locked in a profit on half for a gain of 4.97%. And then going forward here, we've had some up days where I took some profits, partial profits. We had down days where I didn't do anything. Every time it moved up here, sold a little into that strength, then it moved down. I'm staying in the trade because my end of our stop is closed below low of this order block. And then here, we just kind of went down, not a lot of profit targets. Well, there was one here. And now over the last week and a half, we have moved up. Profit targets, profit targets, profit targets, right? And so the remaining shares that I have on this particular trade, the remaining shares, right, they are up 5.76%. Again, all starting with the rejection of the high of the order block. So that's USO. MO. All right. Well, MO is also a order block, but this time with USO, the rejection was a high of the order block. This one that I entered on 11.3 at 56.63, this was a rejection of the low of the order block. We went below the order block and then closed back in the order block. So I entered 56.63. I placed my emergency stop 2 ATRs below, as always. My end of bar stop is simply a close below the low of the order block. You can see the entry point was very close to the low of the order block anyway. That is called a good risk to reward ratio. I enter, if the next day it just simply closes below, I'm just out. That's it. Not my trail, not my emergency stop. My end of bar stop had been potentially a very small loss. So I entered here 56.63. I also placed my trailing stop level 1.5 ATRs above, and away we go. Next day up. I don't think enough for a profit target. Next day up. That was a profit target. Sideways, up a little, nothing. Up here, profit target on this day, we did get to trailing stop level. So now in the future, if I have a close below a previous bar's low, I'm going to get out of half. That happened here on the on November 13th. First close below a previous bar's low. I took off half of the remaining shares that I had remaining for a gain of 2.02%. And then we moved up a little bit, another profit target here. We moved down for 4 days, no profit targets, but I'm still in the position because it didn't close below my end of bar stop. And then we moved up here a little bit. We had a profit target here, not much here. And then the last 3 days, we've kind of just gone down. But again, I have a process that tells me whether to stay in this trade. I'm patient with this trade because it has not closed below my stop, right? And so the remaining shares that I have on this particular trade, up 2.29%. Not bad. All right, this was a monster trade. So I entered here. Well, I want to give you the big picture of this trade here. So here's our order block that starts all the way back here on the 6th, on the 2nd of June, okay? Swing low, followed by a swing high, followed by a swing low, followed by a market structure change. And again, it changed market structure here. Were the participants right? Yes, it was. It went all the way up here. So in hindsight, was smart money buying here when in the future the price got here? Yeah, clearly it was. So again, I'm looking at this as smart money. So I'm not buying this breakout, but I'm looking at this like if we come back to the smart money area, that's where I'll be looking to buy. So I take the high and the low of the order block, I move it into the future. Well, it did come back to the order block. I didn't take this trade, unfortunately, but it's a good example that it came back to the order block. And was it smart money again? It was. Look what happened. That stock tripled from the rejection of the high of the order block, but I didn't take the trade. And I just had to look at, well, if it comes back to the order block again, I will consider it. Well, that's exactly what happened. Now, this is a little bit of an unorthodox trade. It did not come back to the top of the order block, but it did reject the black line, which is the 200-day moving average. So I trade order blocks. I trade major moving averages. When I trade major moving averages, I call this deep dip buy. That's my deep dip buy stock trading strategy. And this is when I took the trade. I took the trade here on 11/17. Why? Because it rejected the 200-day moving average. So I entered the trade, and it was very close to the top of the order block, I might add. So I entered the trade. I position sized. I placed my emergency stop. How far below? That's right, 2 ATRs below. So if I entered here and it immediately went against me and got to my emergency stop, remember I'd lose 1%. My end of bar stop on this trade is just simply a close below this 200-day moving average, the black line. That's it. So giving me a good risk to reward ratio to start the trade. Okay, so entered here, 488, emergency stop, 2 ATRs below, end of bar stop, closed below the 200-day moving average. As always, I placed my trailing stop level 1.5 ATRs above my entry. The next day, took right off. Very nice, hit multiple profit targets into this day. The next day, gapped open higher, took more profit targets at that point, and now I'm also in trailing stop mode. The very next day, we have our first close below a previous bar's low. After reaching trailing stop level, what do? I sell half of the shares that I have at that moment, and I locked in a gain of 6.72%. Okay. Going forward, the next day didn't do much, but it did stay above my end of bar stop, which is the 200-day moving average, the black line. Then we moved up a little bit. Then we moved up a little bit. Then we had a big day up here where I hit multiple profit targets, sold into that strength. Next day, again, multiple profit targets into that strength. Next day down. Next day up big, multiple profit targets into that strength. Okay. And here we are now, 759. Now, we got above the 65 RSI uh, the day before. And whenever I get above 65 RSI, then in the future, if I have a close below this 5 EMA, this thin blue line, that's the end of the trade. And so very likely that's what will take me out of this trade. If it continues up, I'll continue to have profit targets, the daily profit targets. But at this point, two things can happen. If it goes higher and rejects the 70 RSI level, then I'm going to sell half the position there. If that happens, and then after that, if I have a close below previous bar's low, that's the end of the trade as well. Or now that I'm at 65 RSI, if it closes below this 5 EMA, I'll be completely out of the trade. So this is a very easy trade at this point. This trade, monster. This trade, the remaining shares I have on this particular trade are up 35.84%. And again, why did I take the trade? How did I view this trade? If we look at it big picture, I saw the market structure change. I defined the order block. I put the order block into the future, also paying attention to the 200-day moving average. But what happened? We went skyrocketing up. We went all the way down, but we came down to this confluence of the 200-day moving average and very near the order block. It gave me a good risk to reward ratio, and that's why 35.84% on the remaining shares on this trade. Now, I didn't know this was going to happen. All I knew was I had a confluence here with a good risk to reward ratio, and I have a process to follow it if it really goes my way. And that's exactly what I've done. Been a great trade. All right. Let's go to Shopify. Okay, Shopify is also a order block trade. You can see here's the green box. The order block on this particular trade started all the way back here on the 2nd of September. Swing low, swing high, lower, swing low. Market structure change. Was the market structure change correct? Yeah, it was. And again, when we're way up here and I look back here to the order block, is it fair to say when the price is up here that this was smart money? 100%. So bring the smart money into the future. If it comes back down to the smart money area, I may consider taking the trade. And that's exactly what I did. I entered on the 18th of November at 140.47. Okay. My position size, I placed my emergency stop 2 ATRs below my end of bar stop, close below the order block here. Place my trailing stop level 1.5 ATRs above. Next bar takes off, profit targets. Next bar, multiple profit targets. Now I'm in trailing stop mode. Next day down, no profit targets. Next day up, profit targets. Then we kind of squoze our way up, really no profit targets. Here on the 1st of December was our first close below previous bar's low after reaching trailing stop level. I took off half of the remaining shares for a gain of 5.83%. And then, of course, over the last few days, it has moved up. Profit target here, profit target here. And the remaining shares that I have at this moment up 12.78% on this trade. Again, it started with an order block entry. FXY. FXY is the Japanese yen. Okay, I entered the Japanese yen here on November 20th. It's an order block from the past. On this particular day, we rejected the bottom of the order block, not the top, but the bottom. We went below it by just a little bit, closed back in it. I entered 58.33. I position size. I place my emergency stop 2 ATRs below. My end bar stop is simply a close below the order block. You see how close I am to the low anyway, so that's a good risk to reward ratio. I place my trailing stop level 1.5 ATRs above. Next day, gaps open, goes up, multiple profit targets. Right off the bat, I am in trailing stop mode. Next day down, but it didn't close below previous bar's low. Next day up, more profit, another profit target. This day here on the 26th, it did close below a previous bar's low. So what do? I took half of the shares off for a gain of 0.78%. Then we moved up. We moved up strong here, more profit targets. We had to move down, moved up, more profit targets. So at this point, I have sold half, right? Closed below previous bar's low after each trailing stop level. And the remaining shares that I have on this particular trade up 1.52%, which is quite a lot on a currency, by the way. Okay, let's go to MasterCard. I did buy MasterCard here on the 19th of September. Why? Very simple. Rejection of the low of the order block. During the day, we went below it. At the close, we closed in it. I got long, $530.38. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the order block. You can see the very next day, it went down, but it didn't close below. Had it closed below by even 1 penny, I would have gotten out of the trade. But it held. Placed my trailing stop level 1.5 ATRs above. Next day, up, profit target. Next day, up, profit target. Next day, nothing. Next day, up, profit target, where I took off 10% of the remaining shares I had. Also got to trailing stop level. And then finally here on December 1st, we had our first close below a previous bar's low after reaching trailing stop level. What do? I sell half of the remaining half of the remaining shares that I have for a gain of 2.51%. Next day up, profit target. Up here, profit target. Next couple days or last couple days, no profit targets. And the remaining shares that I have on MasterCard up 2.82%. Not too bad. Microsoft. All right. Back to order blocks. On the 21st of November, I got long Microsoft at 472. Why? Rejection of the bottom of this green order block. Look how close my risk to reward is. The very next day, if it closes even 1 penny below that green box, I'm out. So rejection of the bottom of the order block, got long 472.10. Emergency stop, 2 ATRs below as always. End of bar stop, just simply a close below that order block. Next day, it went below it during the day, didn't it, right? But I base everything on the closing price, but it closed back in, kept me in the trade. Next day, tried it again, went below the order block intraday, but by the end of the close, it closed in the order block, kept me in the trade, okay? Placed my 1.5 ATR trailing stop level above. Next day here, profit target. Next day here, profit target, and what else? I'm in trailing stop mode. So now going forward here, first close below previous bar's low after reaching trailing stop level. What do? I take off half of the shares that I have for a gain of 1.33%. And then the last couple days, it's moved up a little bit, really not enough for a profit target, but moved up, which is good. And so the remaining shares that I have on this particular trade are up 2.32%. But remember, as long as this stays above and closes above the low of this order block, I'm going to stay in the trade, take partial profits, right? If it goes higher, okay, gets to a 65 RSI, then then the 5 EMA comes into play. If it rejects the 70 RSI, then I sell half. After rejecting the 70 RSI and selling half, if in the future it closes below previous bar's low, then I'm completely out of the trade, right? So you got to have a process to tell you what to do at all times. If then statements. If this happens, then I'm going to do that. If that happens, then I'm going to do this, right? This is how I trade. This is what I teach my students. But whether you learn it from me or someone else, you've got to get yourself a process. Just trust me. You've got to get yourself a process that you can follow. In the long run, you're always going to come out better doing this than just impulsive trades on a day-to-day basis. Okay? So the remaining shares up on Microsoft up 2.32%. T-Mobile, TMUS. Okay. All right. I got long T-Mobile here on the 24th of November at 206.87. Why? Rejection of the bottom of the order block, right? We have a new order block that's formed down here, but I took the trade based upon this order block. It went below the low of the order block, closed back in the order block. Great. Got long 206.87. I placed my emergency stop 2 ATRs below. My end of bar stop, simply a close below the low of the order block. I'm so close to it just to begin with on my entry. And then I placed my 1.5 trailing stop level above. T-Mobile really hasn't done much. It's just gone sideways. I did hit a profit target here. I did hit a profit target here. But really, it's just moved sideways. But I'm still in the trade. It hasn't closed below the low of the order block. It hasn't got to trailing stop level. So really, I haven't had to do anything, right? So the remaining shares that I have on TMUS at this moment, up 1.4%. Not bad. Okay, I did enter a short position on Friday on XLF. So the bullish order blocks are green, right? But there is also such thing as a bearish order block, which are red. So here is, just for example, here is a green order block. And this would have been a great trade. When we came back into the order block, was that the place to buy? The bullish order block? Yeah, sure was. Came right into the smart money area and bounced from there. But we are now in what is called a not so smart money area, right? I don't want to, I hate to say dumb money, right? But it's essentially what it's called. So why is this a dumb money area, or in other words, a bearish order block? Well, remember, on our bullish order blocks, we want to swing low, followed by a swing high, followed by a lower swing low when a market structure change. Well, you flip everything on its head when you're looking for bearish order blocks. Look, we have a swing high, followed by a swing low, followed by a higher swing high, and a market structure change. Well, when you're looking for bearish order blocks, if you have that swing high, swing low, higher swing high, market structure change, now you're looking for the highest up bar close prior to market structure change to the downside. And this is it here, right here. This is our top bar right here, the high and the low of this highest closing bar before market structure change is our bearish order block. So if we look if we go back and we kind of do this exercise again, people that bought here, they bought here and then it went straight down. Would you consider that smart money? I wouldn't. If you buy here and the market goes straight down, I would not consider that smart money. I would consider that the opposite of smart money. Okay. So now we are back in the area that was considered not smart money. So that is why I took the short trade. And I took the short trade because we rejected the high of the bearish order block. We went above it, but yet we closed below it. So the market rejected it. There were no more buyers up at this level. So I have taken the trade. This is a new trade. I got short 53.68. I position size. Of course, I placed my emergency stop 2 ATRs above. If I get up there, how much do I lose? 1% of my account. But where's my end of bar stop? Simply, my end of bar stop is a close above the high of this order block. So this this is a lot closer than the emergency stop. Okay, so I got short here 53.68. I placed my 1.5 ATR trailing stop level below me because I'm short, right? And I'm completely break even on the trade because I did it at the end of the day. But it's a good example of showing the bullish order block. When it came into the bullish order block, the green, was it correct? Yeah, it certainly was. Bounced right from there. But the opposite side of the coin here is that now we are in the bearish order block, and that's why I took the short. All right, so just to recap, well, I guess we'll do it this way. No, we'll do it this way. LMT. LMT is a trade that was not a positive trade, and let me explain to you why. So this was an order block trade, LMT, that I took on the 25th of November, right here at like 44.49.50. Why? It rejected the bottom of the order block, but this one just didn't work, right? Got in 44.49.50. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. I placed my 1.5 ATR trailing stop level above. Next day went up. Next day went up. But then look what happened here. On the 1st of December, we had a big, huge down bar, right? And it moved down. I got out here because it closed below the low of the order block at 442.20 for a loss here of 1.63%. So they don't always work, right? They don't always work. Sometimes it rejects the bottom and it closes below. You just got to take your lumps. You just got to get out. I wish they worked all the time, but they don't. But the key is they work a lot more than they don't. But this is an example of one that didn't. I got out for a loss of 1.63%. And then look, right after that, went right back up. But that's trading. That happens. I didn't get back in. I got out because it closed below my stop. I followed the rules and I had to take a loss of 1.63%. So on the dailies, just to kind of put this into perspective, they're not all winners for sure, but a lot more winners than losers. USO, remaining shares I have up 5.76%. MO, remaining shares I have up 2.29%. TMC, remaining shares I have up 35.84%. Shopify, remaining shares up 12.78. FXY, remaining shares up 1.52. MasterCard, remaining shares up 2.83. Microsoft, remaining shares up 2.32. T-Mobile, remaining shares up 1.4. XLF, just got into that short trade. And then LMT exited the trade for 1.63% loss. All right, so those are the daily positions. Now, I also trade weekly shares, so let's go to the weeklies. Each bar is a week here, so that means the closing on a weekly bar, the closing bar is Friday, so I need to make my decisions on a Friday, and this is what I did on UUP. So I entered UUP on the weekly bars all the way back July 11th. Why? Multiple confluences here. You can see the green order block. We closed above the order block. So I entered 27.21 because it rejected the high of the order block. In addition to that, it also rejected the 200-day moving average, or the 200-week moving average. Okay, so this is a combination of an order block trade, rejection of the high of the order block, but also a deep dip buy trade with a rejection of the 200. The week before, we closed below the 200. The next week that I entered, we closed above. Either one of those is a legitimate signal. Rejection of the high of the order block, legit entry signal. A close under, close over the 200, also a legit signal. But what happened? On this week that I bought it, both happened. Close under, close over 200, and a rejection of the high of the order block. Multiple confluences improves the chances of having a profitable trade. So I entered here 27.21. I placed my emergency stop 2 ATRs below. My end of bar stop on this trade, because it involves the 200-week moving average, is simply a close below the 200-week moving average. I placed my trailing stop level 1.5 ATRs above, and away we go. Next bar, profit target. Next bar down, no profit target. Next week up, multiple profit targets. I'm also in trailing stop mode now. Next week down. Next week, we have our first close below previous bar's low. So what do? I sell half of my position for a gain of 0.51%. Then we move sideways for about a month. Then here, this was a key week here. We went down. I was like, oh, I'm going to have to get out of the trade. Oh, wait, no. By the end of the week, it did close and recover and close above the 200 week. That kept me in the trade. Next week up, profit target, but next week nothing. Next week up, multiple profit targets, which is really great. And we have just gone up and up and up. And so the remaining shares that I have on this weekly UUP trade up 3.13%. And then last XLV, I did exit completely this trade. And this is a good opportunity to show you the rules of why I exited this. So I got into XLV all the way back here on the 8th of August. Why? Again, it's that combination of a deep dip buy and a order block rejection happening at the same time. It's the confluence. Okay, I got long here 130.07 because first of all, it rejected the 300-week moving average. It's a bounce at the 300-week moving average. That's a deep dip buy. But in addition to that, it rejected the high of the order block. Okay, so I got long here 130.07. I position size. I placed my emergency stop all the way down here, 2 ATRs below. My end of bar stop on this particular trade is simply a close below the orange line, simply a weekly close below the 300. Well, never happened. Next week, up, profit target. Next week, up again, profit target. Now I'm in trailing stop mode. Then we have about 4 weeks of just sideways motion. And then here on the 26th, we have our first close below a previous bar's low after reaching trailing stop level. I take off half of the shares that I have for a gain of 3.99%. Next week, skyrockets up, multiple profit targets. Then we kind of move sideways, one profit target here. We move sideways for a month. Then we have another big thrust up with multiple profit targets. Next week, another profit target. Next week, another profit target. Now, I exited everything Friday on this trade. Why? Because let me show you, give you an example. One of the rules that I use and I teach is when you close above a 70 RSI, and you can see the week before we were at 71.22, and then this week we closed at 63.34. So that is a rejection of the RSI. We closed above and then we closed below. Normally, at that point, I would take off half the remaining shares that I have. But the reason I exited the entire trade was that if you reject the 70 RSI, you take off half. But then in the future, if you have a close below a previous bar's low, you exit the whole thing. This happened in one fell swoop. This day, last week, we were above 70 RSI. This week, we closed below 70 RSI, and we also closed below the previous low. So I exited the trade, done with the trade. But what a trade. The remaining shares that I had on that trade locked in a gain of 15.19%. So anyway, I hope this is helpful for you to get an idea of how I trade, what my process is, how I try to be patient with the trades that I have and try to be very impatient with the ones that don't move my way. But that's really, in the long run, that's the key to making money, everybody. Being patient, waiting for a very good setup to get in, having a position sizing correctly, having a very good risk to reward ratio, having those confluences of signals and areas aligning at the time you take the trade. And then if you're wrong, getting out quickly. And if you're right, staying in. And that's how you get it done. That's how you get it done. So, all right. So those are all the trades. I know there was a lot of them. But I think it gives an opportunity to look at a lot of different markets, a lot of different entries, and how I manage those. So before we get to the potential trades for next week, let's spend a few minutes to talk a little bit about trader psychology, and hopefully this will be helpful as well. Okay, so this weekend's trader psychology post comes from Steve Burns, like it often does. Steve's a great guy. He's a friend of mine. Very famous trader, very famous author. You can check out all his books on at Amazon. Amazon has all of his books. He has such great books. Read them. You will learn a lot. My favorite is Moving Averages 101. I was lucky enough to write the foreword for that book. But you'll learn a lot from that. And reading that book, you'll see how I incorporate a lot what's in that book in how I trade. But let's see what Steve has to say today. When supply or demand zones align with Fibonacci levels, moving averages, or trend lines, you found confluence. When three or more factors agree, you found institutional decision points. Trade those. Well, Steve is 100% correct, as always. And you hear me talking about confluences, looking for confluences of signals or levels happening at the same time. This is exactly why I tell you this. Because, like Steve says, when three or more factors agree, you have found institutional decision points. These are areas where the large financial institutions come in and make decisions at areas. That's why you will see these areas, these confluence of areas. If you get a reaction at these areas, and what I mean by a reaction is like a close under, a close over, an order block, an intraday rejection, you see the institutions making decisions at this area. And if you trade with the institutions, when the institutions trade, you're going to have much better results than buying way at the top when all the retail traders are buying. So that's why every week I say, look for confluences, look for confluences. Look, if you have a confluence, for example, of an under 30 over 30, okay, there are certain groups of buyers that buy under 30 over 30. That's a deep dip buy signal, by the way. You have other areas, or you have other groups of buyers, for example, 200-day moving average buyers. If it rejects the 200-day moving average and closes under, closes over, they buy. Okay, well, now you have the under 30 over 30 group buying. You have the 200-day moving average group buying. Let's say you reject the bottom of an order block. Okay, well, now you have the order block people buying. Now you have three separate groups of buyers buying at the same time. And so if you can put yourself in a position where many groups are buying at the same time, you're just going to have a higher rate, a higher chance of having of a potential trade. And if you are buying when institutions are buying, you have a lot of power behind that. You want to be in phase with the institutions. So when supply or demand zones align with Fibonacci levels, moving averages, trend lines, I use trend lines also, right? You found confluence. When three or more factors agree, you found institutional decision points, trade those. I could not agree more. So this sounds like technical analysis, not trader psychology. Well, it is trader psychology because it is called patience. You need to be patient and wait for these confluences and have the discipline not to get into trades unless you have legitimate setups, right? So it's all circular. It's all about being patient, waiting for good signals, good risk to reward ratios, position sizing correctly, right? There's a lot to trading. There is a lot to trading. But thank you, Steve. Please follow Steve at S. Joseph Burns over on Twitter or X. And again, check out his books on Amazon.com. All right, let us start taking a look at the potential trades for next week. I don't have a lot of them this week, but I do have 6 on the daily and 1 on the weekly charts that I want to take a look at. Now, I always give you this disclaimer that, okay, here we have 6 potential trades for next week. It is possible that all 6 of these could trigger all on the same day. Does that mean I would take all 6? No, it does not. I have a rule. I only take one trade per day or per time frame. Even if I have 6 candidates, I'm only going to take one. So if they all qualify, I've got to look for the one that qualifies the best. And how do I do that? Well, I give it a score. I give them a score. For example, if one has one signal, okay, I give it a 1. If another Stock has two signals. I give it a 2. Which one do you think I'm going to take? I'm going to take the one that's 2 instead of 1, right? There may be one that's 4, right? But then I have to, I could have 4 signals, but the risk to reward ratio could maybe is not good. So I have to factor that in. So it's a process of elimination of analysis of coming down to the best trade. And this is what I teach all my students. I also look at the higher time frames, I look at relative strength and so forth. And so this is what I do, this is how I trade, this is what I teach my students, the small, the minutia, the devil's in the details on these trades, and this is what I teach. And by the way, I do teach a private one-on-one course. I have taught people from all over the world, all the way from beginners all the way to the hedge fund level, and I teach a 20-hour course. So it's a lot of hours. It's a serious course, but if you really want to learn something, really honestly, the best way to do this, in my opinion, is one-on-one with your instructor. And that's why I offer this course. And I've taught so many people. I've trained so many great traders, and I teach them all the strategies that I use. We do a lot of simulation trades. Um, it's 2 hours a week for 10 weeks. It does cost $2,000, which is a lot of money, but listen, you are going to learn a skill that you can use the rest of your life. And so if you would be interested in being my student, if you'd be interested in doing this 20-hour course with me, all you have to do is send me an email, and that would get the process started. Usually when I hear from potential students, I like to have an initial call with them. It's a free call. It's not a sales call. I just want to learn more about the student, their trading, their challenges, their goals, and then it's a good chance for the student to ask me any questions about the format of the course. But if you do become my student, I will teach you everything I know, and you'll have a skill that you can use for the rest of your life. And after 20 hours with me, I promise you're going to learn a lot. So send me an email. We can get the process started. As an alternative, if you like online courses, I have a really good online course available at udemy.com. The link's in the description. That is the Deep Dip Buy course. It's somewhere between $30 and $50, but I teach you step by step how to trade the Deep Dip Buy stock trading strategy. It's 9.5 hours of content. It's really good. I've sold so many around the world. And I think that's like a 4.85 or 4.9 star rating, so you learn a lot. So anyway, those are the two services that I offer. Well, I guess third, if you want to do any consulting, I also consult as well, with different institutions as well. So lessons, online courses, or consulting, very happy to help you any way I can. Just reach out to me. My email's in the link. So, okay, so that's the business end of today, and let's get started and take a look at the potential trades for next week. Okay, so here is AMD. So AMD had this big run up. Now we've had quite a sell-off, right? But we have formed an order block. And again, let's revisit. What is an order block? Swing low. Here's a swing low. Here's this followed by a swing high. We have it. And here we have a lower swing low. So swing low, swing high, lower swing low. What do we have to do? We have to take out that swing high, which happened here. Swing low, swing high, lower swing low, market structure change. As soon as we have market structure change, I need to look for the lowest closing bar prior to market structure change. Here it is, the high and the low of this bar. Move it into the future. Okay, this is the buyable area inside this order block. Now, I have 3 options with this trade. I could, if we come down and reject the top of this order block, I could buy there, but the problem is with that is that the stop is all the way down here, which I don't quite like. So what I what ideally what I'm looking for on AMD is this level here, 199.60. Why? Well, this is a level in the order block that I have created. Why this? Because here on this bar, we have this big up bar, okay? When you have a big up bar, from a Fibonacci standpoint, 50% of that bar, halfway of that bar, you're going to have some inherent Fibonacci support. And that is why I drew the line. So what I'm talking about next week, ideally what I'm looking for is a move down a rejection of this 199.60 line, and by rejection I mean it bounces at it or it goes under and closes above it. If that's the case, that would be a potential entry there. Now, if it and then if that happened, my stop would simply be that 199.60. So that would give me a very good risk to reward ratio. Alternatively, if we go lower and reject the 100-day moving average, that's the red line inside the bullish order block, and that is at 194.96. That would also be a potential, right? So those are really what I'm looking for. I'm either looking for a rejection of 199.60. If it does reject 199.60, then 199.60 would be the stop, end of bar stop, or again, the rejection of the 100-day moving average that's located inside the order block at 194.96. So that's what I'm looking for on AMD. CCJ, very similar to AMD. We have an order block. Again, let's revisit it. Here's a swing low, followed by a swing high, followed by a lower swing low, and then here we take out the swing high, changing the market structure to the upside. I'm not buying the breakout to the upside. I'm waiting for a move back down. If you break market structure to the upside, the old saying is buy dips in an uptrend. Well, if we've changed market structure to the upside, we are in an uptrend. Therefore, I want to buy dips into the order block. And similar with AMD, I have two levels that I'm looking for on CCJ. The first level would be here, 79.80. Why 79.80? Well, if we go back, there's something called the V2. My students know about this. You've heard me talk about this. V1s and V2s, in this case, it's a V2, consists of three bars. Bar 1, bar 2, and bar 3. Bar 1, bar 2 goes below bar 1's low. Bar 3 closed above bar 1's close. That's a V2. On a V2, the second bar, the washout bar we call it, halfway of the second bar, there again, there is support. Fibonacci support at 79.80. So here's the V2. I know halfway of that second bar is going to be the support. That support by itself is located in the order block. So you have a support area inside a support area. Does that make sense? So that's what I'm looking for on CCJ. I'm looking for a rejection of 79.80. If it rejects that, I would consider taking the trade. My stop would be a close back below 79.80 or a rejection of the low of the order block, which is at 77.55. So either a rejection of 79.80 or a rejection of the low of the order block at 77.55. That's what I'm looking for. It may get there, it may not get there, but if it does, I'll consider taking the trade. Again, it comes back to patience and waiting for it to do what you want to do. IBM, okay, we've red here. Red means I'm looking for a short. Why? Well, because this is a bearish order block. Let's revisit. Swing high, followed by a swing low, followed by a higher swing high, followed by a market structure change. Okay, well, this was not smart money up here. It was the opposite. And if we come back to where it was not smart money before, I would consider shorting it. Now, technically, I could short the bottom of the order block, but from the bottom of the order block to the top of the order block is kind of a long ways away, so it's not a good risk to reward ratio. Ideally, what I'm looking for in IBM is I'm looking for a rejection of this line here, 319. Why? Because of this bar. We have a big down bar. If you have a big down bar and you rally back to halfway of that big down bar, there is going to be inherent resistance there. So again, this is a resistance area within a resistance area. The halfway down, if we rally back up to 319, is a resistance area inside a bigger picture resistance area, which is also the bearish order block. So that's really what I'm looking for a rejection of 319. Alternatively, if it motors up through that, doesn't reject it, and rejects the high of the order block, I could also consider that, and that's at 324.90. But first stop, looking for rejection of 319. Coca-Cola, KO. Okay, so Coke had a good run. It's kind of had a bit of a pullback here. I'm looking for this order block right here. Why is this an order block? Because we have a swing low, we have a swing high, we have a lower swing low. We changed market structure, defining the order block. Lowest bar closed before market structure change. It's kind of a tall order block, but inside that order block are two areas that I'm looking for. And specifically what I'm looking for a rejection of the red bar, which is, or the red line, which is the 100-day moving average, 68.34. So I'm looking for a rejection of that 100-day moving average at 68.34 at the moment. It's going to change every day, but that's my line in the sand. Alternatively, we have a 250-day moving average down here that also would give me another line in the sand or structure to base the trade off of. Again, a moving average is going to be a level of support. The order block is an area of support. So I'm looking for levels of support within levels of support, and that's what I'm looking for. So I'm looking for rejection of the 100-day at 68.34 or a rejection of the 250-day at 67.42. MicroStrategies. All right. So a couple different things here on MicroStrategies. We have changed market structure to the upside. And we have what is called an abandoned baby. Let's start with the abandoned baby. Why is this an abandoned baby? Well, if you have a gap down immediately followed by a gap up, you have what's called an abandoned baby. You can see here on the 28th, we gap down. From open to close, we gap down. And the very next day, from close to open, we gap up. When this happens, when you have a very sudden, quick change from very bearish to very bullish, very often in the future, you are more likely than not to be higher. Okay. So this in the darker green here, this is the abandoned baby. Now, when abandoned babies form, the key support level is the high of the baby. And the high of the baby is 172.18. If we come down and reject the high of that baby at 172.18, I will consider taking the trade. And on abandoned baby trades, when that happens, my strategy is a little bit different because these are so strong that, and I like to mix up the way that I manage the trade a little bit. But on this particular trade, if this happens, it's very simple. I set a 2 ATR emergency stop, as I always do. And then I set a 4 ATR profit target so that my profit target is twice what I'm risking if I'm wrong. And that's all I do. So next week, if we reject the high of 172.18 and I take the trade, 2 ATR stop, 4 ATR profit target, that's it. Okay. Now, in addition to the abandoned baby, we have also we've changed market structure. Here we have a swing low, here we have a swing high, here we have a lower swing low, and then last week we took out the swing high and we have changed market structure to the upside. So that is why not only do we have an bullish abandoned baby here, but we also have a bullish order block going forward. Now, in general, if you have a big up bar, like I mentioned earlier, halfway of that big up bar is going to be support. Well, that support level is at 163. Again, a support level within a support level, right? So I know this one's a little bit complicated, but I have two options here. Rejection of the high of the order block or the rejection of the high of the abandoned baby 172.18. If that happens, 2 ATR stop, 4 ATR profit target. If that doesn't happen and we come back into the bullish order block and reject the halfway of the big up bar there at 163, I would also consider taking that there. But at that point, it wouldn't be the 2 and the 4 ATR. It would be the normal, regular emergency stop, end of bar stop, and then scaling out like I do on most of the regular trades. So anyway, Monster has really gone down. Obviously, Bitcoin's gone down quite a bit, but right now this is looking kind of interesting, but it has not triggered anything that I'm interested in yet. Last but not least, Netflix. So Netflix really got hit on Friday. in a strange way, there was a legitimate entry already on Friday on Netflix. Why? Well, deep dip buy. We went under 30 RSI, closed above 30 RSI. We rejected the negative third ATR channel as well. So that by itself is a legitimate order. Last week I was talking about this megaphone trend line on Netflix. Megaphone trend line is when you connect lower lows. Here's a swing low that we connected with another swing low. You bring that out into time, connected exactly with the other swing low there, right? But then this week we lost that trend line. So on Steve Burns' post in Trader Psychology, he was talking about trend lines as well. So if we can get back above this trend line, that would be a bullish signal. Again, although Friday we went under 30, over 30 and reject the negative third ATR channel. So in a strange way, it's legitimate anyway. I didn't take that, but what I'm kind of looking for is a close back above that trend line. And if we close back above that trend line, I would consider that there's a better chance that a short-term bottom is in, but we still have that trend line above us as resistance. So that's what I'm looking for on Netflix. So those are the dailies. And then again, on the weeklies, I only have one, and it is micro strategies again, but from a different setup on the weekly. And this one's pretty well defined. Again, I showed you one on the daily, but here's one on the weekly bars. We have the 200-week moving average inside of a weekly order block. This is great. This is great if we get there. So what I'm looking for on the weekly next week on with Monster, MSTR, is simply a rejection of that 200-week moving average. The 200-week moving average is 141.23. So it's down there quite a bit, but doesn't mean it can't get there. So I'm not interested in taking the trade unless on this weekly time frame, unless it goes down, test that 200-week, closes above it. If it does, I would consider taking the trade. My end of bar stop would simply be a close below the 200-week. So anyway, that is what I have for this week's podcast, everybody. I hope you found it helpful. If you have any questions, please feel free to put them in the comment section. I'll do my best to get back to you. I hope you have a really good rest of your weekend. I hope you have a good trading week next week. If there's anything I can help you with, either with teaching, consulting, please let me know. But love to have you a student. I will teach you everything I know. I always like to leave off with, please try to go out and do something nice for another human being every day. If we did this, if everybody did one nice thing for another human being every day, the world would just be a better place. It just would, it, right? And if you could also go out and try to do one nice thing for an animal each day, or whenever you have an opportunity, they appreciate acts of kindness just like we do as well. So thank you so much, everybody, for watching the podcast this weekend. And I hope you have a really good rest of your week. And God willing, I will see you next week. Thanks so much. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.